statement of profit or loss and other comprehensive income there for the year which ended 31st of October 2025. We have the revenue, we have the cost of sales, gross profit, distribution cost, admin expenses, profit from operation, finance cost, investment income, which are basically dividends received. And then we have the profit before tax, income tax expense, profit for there. We have other comprehensive income, which include gain on property devaluation. And then we have the fair value gain on equity investments. Then we have the statement of financial position basically for 2 years, 2025 and 2024. We have the non-current asset, which comprises of property, plant and equipment, investments in equity instruments, and then we have the current assets, which comprises of inventory, trade receivables, cash and cash equivalent. Then we have equity, which comprises of ordinary share capital, share premium, revaluation reserve, financial asset reserves. And then we have the retained earnings. We have the total equities here. Then we have the non-current liabilities, which comprises of 12.5% loan stock, deferred tax. And then we have the current liabilities comprising of trade payables, current tax. And then we have the total equity and liabilities. We have additional information, number 1 all the way to note number 6. So what are we required to do here? We are required to prepare a statement of cash flows for 𝐉𝐻𝐂𝐔𝐒 Limited for the year which ended 31st of October 2025. Basically, we are required to use the indirect method. So the first thing we need to do here is we go through the additional information number 1, 2, 3, 4, 5. We see whether there are some workings which are required, we do them, and then from there we prepare what is required. So we will start with the additional information number 1. Additional information number 1, and we are told that the property, plant and equipment comprises of the following. So in that case, you're given the property, plant and equipment for 2 years, 2024, 2025. Remember, the current year ended on 31st of October 2025. So those balances for 31st of October 2025 are automatically the closing balances, and 31st of October 2024 are opening balances. So we have the costs. That one should be cost or valuation at the start and also at the end. We have accumulated depreciation at the start and also at the end. We have carrying amount. Carrying amount is the same with the net book value. And then, okay, in this case, there are 2 accounts we are going to prepare. We'll be able to explain why, but I think we will prepare those 2 accounts after we have gone through the additional information number 2, 3, up to note number 6. In that case, we are going to prepare 2 accounts. The first one is the PP account, basically to determine whether there was some PP which were acquired. Remember, just like the other question we said, in case there are some items of PP which were acquired, the examiner will not give you that. It's upon you to do what? Basically to prepare the PP account to determine what? The PP which were acquired during the current year. Number 2, we will also prepare the accumulated depreciation account. The main objective of preparing that account is basically to determine whether there was or actually to determine the depreciation for the current year. But basically, we're going to prepare those 2 accounts after going through the other additional information. So let's first of all go to note number 2, and you're told on 1st November 2024. This is at the start of the year. The company revalued its property for the first time to a fair value of 24 million. So in this case, if you are told property usually comprises of land and buildings. So property to its fair value of 24 million. So we are told the cost of land is 6 million. So automatically the difference here is the cost of buildings, because we are told a property, we are given property fair, and actually in this case we are told the property was revalued. So the revalued amount in this case we are told is 24 million. And I hope you can see our figures in the income statement of financial position. Those values are in thousands of shillings. So we need to be consistent. We will work with our figures in thousands of shillings. So the property, which I've said comprises of land and buildings, land and buildings. This one was revalued to this one, 24 million. And basically we are told that the cost of land, or basically the revalued amount of land here is what? Is 6 million. So automatically the difference here, which is 18 million, this is the revalued amount of what? Of buildings. This is the revalued amount of what? Of buildings, because I've said property comprises of land and buildings. Yes. And then you're told the property had a cost of 25 million. So the cost of land in that 25 million is 5 million, and the building was being depreciated on a straight-line basis at the rate of 2% per annum, and had a remaining useful life of that year at the date of the revaluation. At the date of what? Revaluation. So, and then we are told that the company does not account for the deferred tax on this revaluation. There is a topic we're going to discuss on deferred tax, and basically we'll be able to see that anytime the company revalue an item of PPE and there is a revaluation gain, the company usually computes something called the deferred tax on the revaluation gain. But if you check here, we are told the company does not account for that deferred tax on the revaluation gain. However, it makes an inter-reserve transfer for excess depreciation upon what? Revaluation. So I think in our case, what we need to do here is basically to compute what? We need to compute the accumulated what? Or actually, we need to compute the excess depreciation here. The excess depreciation. Do we compute it at this point, or we compute it as we prepare the PP account? Yes, let's compute that as we prepare the PP account. Remember, I said we need to prepare the PP account and the accumulated depreciation account. So yes, let's first of all skip that. We will basically come back to that equal to note number 1. So let's first of all we move to note number 3. And in note number 3, we are told during the year which ended 31st of October 2025, a motor vehicle which had a cost of 2 million and accumulated depreciation of 800,000 was disposed of for a cash profit of 1080. The gain or loss on disposal was included within the distribution. I think this one is quite simple. Because we are told there was a motor vehicle which was disposed. Remember, I said that anytime the company disposes or sells an asset, we need to compute the gain or the loss on disposal. How do we compute this particular gain or loss on disposal? We take the sales proceeds, minus the net book value, or basically the carrying amount, of which we say that this one is equal to the cost minus the accumulated what? Depreciation. So in our case, we are told the motor vehicle, which was disposed as per note number 3, was disposed, or actually we are told its cost was 2 million and accumulated depreciation of 200,000. So the cost was 2 million, and you have said we are working with all our figures in thousands of shillings. The accumulated depreciation was 800,000. So meaning that the net book value of the carrying amount, this one was 12. And then you're told it was disposed for 1020. That is the profit. So meaning that here it was sold at an amount which was less than the carrying amount. In other terms, if you take this minus that will give us a negative. That one will give us a negative, which automatically is the loss on disposal. So what is the loss on disposal here? Is it 180? The loss on disposal? The loss on disposal, is it 180? Is it 180? Is it 180? 180? Yes, 180. So remember, when preparing the statement of cash flows, there are 2 items you're going to consider here. Number 1, this one, the loss will have to be added to, will be added back to the profit before interest and tax. And number 2, when computing the cash flow from investing activities, we said we take into account the sales profit. How much amount was received from the sale of that asset? So we are done with that. So, but also remember this information which we have in note 3. We will also use this when preparing the PP account. Let's move to note number 4. And you're told the company acquired new investment in equity instruments for a cash and designated them at fair value through other comprehensive income. Remember, in the topic of financial instruments, we talked about financial asset. Financial asset, we said it is investment in equity instrument. It is investment in shares. So we are told during the current year, the company acquired new equity, or actually the company acquired new investment in equity shares. In other terms, the company acquired additional investment in what? In shares. And actually designated that, or actually classified those particular investment as at fair value through other comprehensive income. Now, where do we have information about that? Where do we have information about the financial asset? Remember, this was the abbreviation for those financial asset at fair value through other comprehensive income. And remember, we said that these are equity instruments which are acquired by the company, and the company has an intention of holding them on a continuing basis. The company has an intention of holding this equity instrument for a long period of time. That's why we say these ones are basically classified as non-current assets. If you go back to the balance sheet of this company, specifically at the non-current asset, you'll be able to see something called equity or investment in equity instrument. Now, that investment in equity instrument basically is what is a financial asset at fair value through other comprehensive income. Investment in shares, the company intends to hold these shares for a long period of time. Now, here you can see at the start of the year, the value for this equity instrument was basically 0, but basically it has increased all the way to 12,100. That's why we are told in note number 4 here, this investment in equity instrument was acquired during the current year. So in this case, you can see therefore, this has an increase of 12,100. But remember what we said, this particular investment in equity instrument, they're recorded in the statement of financial position at their fair value. So they must be remeasured to their fair value at the end of each year. Now, if you can be able to recall in the income statement, can you go back to the income statement? Can you go back to the income statement? In the income statement down there, where we have the profit for the year, we have other comprehensive incomes. Now, these other comprehensive incomes, basically, we have 2 items. We have the gain on property evaluation, and then we have fair value gain on equity instrument. So basically, this investment in equity instrument, which was acquired by the company during the current year, their fair value increased with 600,000. So the company bought some shares during the current year, but when the year was coming to an end, their market value had increased with 500. Now, in our case, what we want to do here, we want to determine how much cost was paid by the company in acquiring these shares. So automatically to be able to determine the cost, because whatever you're given here, this is the fair value. And this fair value of this equity instrument, this one includes the gain. Include that gain. Can you be able to know how much amount was paid by the company? For example, you bought some shares during the current year. We don't know the amount which you paid, but we know that at the end of the year, these shares will be having a value of 50,000. But equally, we are told that the value for these shares has increased with 10,000. Now, in this case, can we be able to determine the cost you paid in acquiring these shares? Because that's what we need to know here. So we know that the market value of the shares at the end of the year was 50,000. The market value increased with 10,000, but we don't know the cost you paid. Can you be able to determine the cost which was paid here? Then, can you be able to determine the cost which was paid here in acquiring these shares? I hope you're understanding this, whatever I'm explaining here. We are saying you bought some shares during the current year. The shares which are trading in the securities exchange market. Now, the value of those shares at the end of the day is 50,000 shares. At the end of the day is 50,000. And we are told since you bought those shares, the market value has increased with 10,000. Can you be able to determine the cost which was paid in acquiring those shares? Determine the cost which was paid in acquiring those shares. Can you be able to tell the amount? Can you be able to determine the cost you paid in acquiring those shares? Yes, it's automatically very, very simple, this one. It's automatically very simple. Dagote, can you be able to determine the cost? Yes, the cost is automatically the market price minus the increase in the fair value. So you bought them at 40,000. You bought them at 40,000. And if you add this increase in the market price, you get the fair value at the end of the year. The same case here. The shares which were bought by the company, we are not given their cost, and that's what we want to know, how much cash was paid, but you are given their fair value at the end. But we know that this fair value has increased with 600. Has increased with 600 as per the income statement. So meaning that we can be able to know, to determine the cash which was paid by the company. So the cash which was paid by the company in acquiring this equity, this investment in equity instrument will be this minus that. So how much is that? It is 11 what? It is 11,500. That is what we want to determine, because in preparing our statement of cash flow, specifically when computing the cash flow from investing activities, our interest here is basically to determine, our interest is the cash which was paid. The cash which was paid is not this one. The cash which was paid is 12,600, which is the market value, minus that gain, minus increase in the market price, minus that increase in the market what? Minus that increase in the market price. Yes. Now we have that. Note number For note number 5, we are told during the year which ended 31st of October 2025, our company made 145 bonus issue of ordinary shares with rising share premium. We came across this in our previous class. We said once the company make a bonus issue, there is no money which is received here. So let's first of all we determine the bonus shares. How many shares were issued free of charge? So we are told the company issued 145. 145, how do we interpret that? We interpret that, or basically that means that during this bonus issue, the company was to issue 1 share for 5 shares which were held. Now in this case, we said we need to determine the shares which were held at the start. So we go back to our balance sheet at the equity. And we take the share capital at the start. The share capital at the start was 20. I hope you can see that. But basically, these are not shares. We say divide that with the par value per share. The par value per share is what? Still in our balance sheet where we have the word ordinary share capital, the par value is 10. So meaning the shares which were held at the start, they were 2,000. So we cross multiply, then we divide. So in this case, we have 1 times the 2,000, that is, divided that with 5. And basically, this will give us what? This will give us 400 shares. So the shares which were issued during the bonus issue were 400. And remember, in this case, we said during a bonus issue, the shares are issued at their par. Exactly the same thing we did in the other question. So that is these are the shares which were issued during the bonus issue. Now, meaning that this particular 400 shares, and I hope my computation is correct. So the 400 shares which were issued at a price of 10, so the company received 4,000 shillings. So how do we account for this amount? We say that this one should be credited in the share premium account. And then we credit the ordinary share capital account. We credit what? The ordinary share capital account. That is basically the double entry for this. And therefore, we said in relation to this bonus issue, we have to prepare 2 accounts, the ordinary share capital account and the share premium account. So why do we have to prepare those 2 accounts? For us to be able to determine the shares which were issued for cash. So let's prepare those 2 accounts. We prepare those 2 accounts. And I hope you can see this question, in fact, has so many similarities with the other one which we did. Because also in that question, we had a bonus issue. There was a disposal of assets. Yes. So let's start by preparing the ordinary share capital account. And then the share premium account. And I've said the reason why we are preparing this account is to determine the shares which were issued for cash. And in this case, I said whatever you record in this account is the opening balance. The closing balance, we record it here. The closing balance. Then this bonus shares must be credited in this account, the bonus shares. And we know the bonus shares at this value, 4,000. And then this account mostly will be having a balancing figure on this side. And these are the shares which were issued for cash. That is what we want to determine, which will be the balancing figure. Then we do the same. We record the opening balance in this account, the closing balance. Then these shares which were issued free of charge, the bonus shares, we are saying they should be debited in this account. So we have the bonus shares, which are the value of 4,000. And then we will have a balancing figure on this side, which now will be the cash, which was received from the shares which were issued. These shares which were issued, you'll be able to see they were issued at a premium, which will be the balancing figure here. So let's first of all start by recording the opening balance and the closing balance in the share capital. We get this from the balance sheet at the equity. From the balance sheet at the equity, the ordinary share capital at the start, this one, was 20. At the end was 40,000, like that. Yes. So then if you balance this account, you can see the total on this side is 40. The total on the credit is 24. We have a difference of what? We have a difference of 16,000. Now this 16,000 automatically are the shares which were issued for cash. And that is what we consider in our statement of cash flows. The same case here, we record the opening balance. We are getting this balance from our balance sheet at the equity. The opening balance here is 4,000. The closing balance here is 4,000, 4,000, 4,000. So the total on this side is 8,000. The total on this side is 4,000. So meaning that we have a balancing figure here of 4,000, and this is the share premium which was received in cash. That is what we are going to consider in preparing our statement of cash flow. Sasa, that is what we will call point number 5. And then I think point number 6, we are told all the sales and purchases were basically made on credit. Okay, so I don't know how that is supposed to help us, but I don't think we have any working for that. Now, what I want us to do, I want us to go back basically to point number 1, 2, and 3. There are basically a number of accounts we need to prepare there. The number of accounts we need to prepare there, the PP account and accumulated depreciation. I hope you can see, for example, with this question, like unlike the other question which we did, we are not given the depreciation for the current year. Are we given the depreciation for the current year in the additional information? No. We can only compute that by preparing the accumulated depreciation account. In this question, equally, we are not told whether there were some items of PP which were acquired. So we can only be able to do that by preparing the property, plant and equipment account, of which in this case, we'll be able to see that in terms of how we prepare this account, there will be a slight difference because the PP account here, we have to prepare it at cost. And then we prepare another account, which is called accumulated depreciation account. But I think before we do that, let's, first of all, we go to note number 2. There is something we need to compute in relation to note 2. So let's go to note 2 first of all. We are told on 1st November 2024, which is at the start of the year, the company revalued its property, of which I've said property is land and buildings, for the first time at a fair value of 24 million. Fair value is the same with the revalued amount. So if you're told assets were revalued and you're given the fair value, that is the same with the revalued amount. So 24, and actually we are told that included here is the revalued amount for land, 6 million. So meaning that buildings were revalued at 18 million. And then we are told the property had a cost of 25 million. The property, this property which was revalued, had the cost of 25 million. And you're told included in that 25 million is the cost of land. Is the cost of what? Is the cost of land. Cost of land. So I think maybe before we move to the other event, to the other sentence, remember, anytime the company revalue an asset, we usually have a revaluation gain, or basically a revaluation what? Loss. Anytime the company has revalued an asset, we have a revaluation gain or a revaluation what? Loss. Now, how do we compute this revaluation gain or loss? Basically, to compute this, we compare two values. We compare the revalued amount, which in other terms is the fair value. For example, in our case, we know that this property was revalued to 24 million. So we already have this. So we compare this with the net book value. With the net book value, or basically the carrying amount of the asset, which was revalued. And then in this case, we get a revaluation gain or a revaluation loss. Now, in this particular question, the examiner has not given us this. Because if you check on what you're given in note number 2, we are given the cost of the property. So are we supposed to compare this with the cost? No. We need to compare that with the net book value. And actually, we know the net book value is the cost minus accumulated depreciation. So we don't have this one. But in our case, we have this revaluation gain. So the revaluation gain, this one, we have it in the income statement. Can you go to the income statement down there? In the income statement, you are told the revaluation gain on property was this one. So can you be able to determine the revalued amount? Can you be able to determine this revalued amount? Yes. The revalued amount automatically will be the difference between these two values there. So how much is that? Is it 17 million? Is it 17 million? Because property was revalued to 24 million. We don't have the net book value, but we have the revaluation gain. The revaluation gain, which is this one. Remember, I'm saying to determine the revaluation gain, you take this one, you minus the net book value. So we have this one, we don't have this, and we have this. So how much amount do we less from 24 million to get 7 million? In this case, I'm saying should be 17. Should be what? 17. Is that the position? Then is that the position? Then is that the position? Yes. So this is the revalued amount. This is the revalued amount. At the date now, this particular asset were revalued. Were revalued. That was the net book value. That was the net book what value. But if you go back to that question, to that point number 2, that is, we are told there was we are given the cost. We are given the cost of this property. The cost of the property at the date of revaluation. And actually the cost here, we are told it was 25. Remember I said, once an asset has been revalued, you compare its revalued amount or the fair value with the net book value, because we know that this property comprises of land and comprises of buildings. Automatically, buildings are depreciated, but basically land are not being what? Depreciated. Yes. So included in this particular cost is the cost of land. And actually, we are told the cost of land is what? Is 5 million. Is 5 million. So mean that the difference here, which is the 20, this now will be the cost of, this will be the cost of buildings. That will be the cost of what? Of buildings. But basically, we are told at the time these assets were revalued, automatically we are saying that this was their net book value. Yes. So now using this information, there is something I want us to compute. There is something I want us to compute as per note number 2. Let's go to sentence number 3 of note number 2. We are told buildings were being depreciated on a straight line basis at the rate of 2%. 2 what? 2%, and had a remaining useful life of that year as at the date of revaluation. So basically what that means is that before the company revalued buildings, the company was depreciating buildings, at the rate of 2%, at the rate of what? 2% per annum. This is how the buildings were being depreciated before they were revalued. So after they were revalued, we are told that now the buildings are estimated to have a useful life of 30 years. So basically what that means is that these buildings which were revalued now will be depreciated on a straight line basis, over the next 30 years. Over the next what? 30 years. So the reason why this information is important, we need to be very clear, because I know these require a lot of understanding. So for you to be able to understand what you want to do next year, you need to understand this. Before the buildings were revalued, this before the revaluation, the buildings were depreciated at the rate of 2% per annum. But after revaluation, we are told buildings are estimated now to have a useful life of 30 years. Yes. Now, why do we need to have this information? The reason why we need to have this information is because of the last sentence of that point. So we are told, however, it made an inter-reserve transfer for the excess depreciation upon revaluation. So automatically, the moment the company has revalued a building, its value increases. Its value do what? Increases. And as a result of that, you'll be able to see that the depreciation which was accounted for during the current year for the buildings is more than the previous depreciation which was computed before the buildings was revalued. So let's compute the depreciation before the revaluation and after revaluation. You see, will the depreciation increase as a result of the buildings being revalued? So for example, before the revaluation, before revaluation, how are the buildings depreciated? The buildings were depreciated at the rate of 2% per annum. And I hope you can see, if it is on straight line, it is automatically on cost. What is the cost of buildings? Buildings before they were revalued is this one, which is 20. So if we get 2% of this, I think that one should give us, is it 400? 2% of this? 2% of that will it give us, it's a 400. 400, eh? Yes, 2%, because we do away with 2 zeros, 400. So that is the depreciation before the revaluation. What about after revaluation? After revaluation. Remember, after revaluation, buildings now will be depreciated, used on straight line basis over the next 30 years. So what we need to do, we need to determine what is the revalued amount of buildings. Who can be able to recall the buildings were revalued to an amount of how much? Buildings were revalued to an amount of how much? Remember, the property which comprises of land and buildings was revalued to this one, 24. So tumesema hii 24 million cost revalued amount ya land ni 6 million, revalued amount ya building ngapi ni 18. So meaning after revaluation, we are going to compute the depreciation for buildings based on the revalued amount. The new value of the building is this. So which is basically 18, and then we are going to depreciate this in the next 30 years. In the next 30 years means to get the depreciation per annum, you take the new value, you divide that with 30 years. So this will give us what? This will give us 600. So in this case, now you can see before the buildings were revalued, the depreciation per annum was 400. After the buildings were revalued upward, the depreciation increases to 600. Now, what is the excess depreciation? What is the excess depreciation? The excess depreciation in this case is the difference here, which is 200. You can see the depreciation increased with how much? With 200. So that is why it was important for you to understand all this. Now, having said, although in an examination setup, to keep a revision, you'll be able to see that all these workings, you don't have to do them in an exam. Basically, we are going to look on some of the shortcuts, which are basically required maybe whenever you are doing these questions, because you can see in an examination setup, you can't be able to do all this. So what I want us to do, I want us to basically move and prepare two accounts here, the PP account and basically the accumulated depreciation account. So let's prepare these two accounts here. So we start with the PP account. And this question here, we will prepare this account at costs. This account will be prepared at cost. Will be prepared at cost. Will be prepared at cost. And then we prepare this other account. The accumulated depreciation account. The reason why we're preparing this account is to compute depreciation for the year. The reason why we're preparing this account is to determine the PP which were acquired. So what do we record in the PP account? So we record the value at the start, and actually remember everything here will be recorded at cost, and then we record the cost at the end of the year. So then on this side we record any revaluation gain, we record acquisitions. Then on this side we record disposal, the revaluation what? The revaluation loss, any revaluation what? Loss. Any revaluation loss? Yes. Then in this account, what do we record? We record the accumulated depreciation at the start. And then on this side, we record the depreciation for the current year, which was taken to the income statement. We record the accumulated depreciation at the end of the current year here. At the end of the current year. And also because there was an item which was disposed, the accumulated depreciation on disposal. The accumulated depreciation on disposal. So we have everything here. The opening balance, the closing balance, this one we have it. So what we want to compute is this. So in this question, we have this, we have this, we have revaluation gain. Automatically, we don't have a loss. We have the item of PP which were disposed. So what we want to determine is that. So let's start with this accounting fact. So we have the opening balances for accumulated depreciation in note 1. The accumulated depreciation in note number 1 at the start, which is the year 2024, is basically 9240. Note number 1, I'm getting that from note 1. The accumulated depreciation at the end, this one, is 10430. Then if you go to note number 3, the motor vehicle which was disposed, remember motor vehicle is part of the PP because these include property, plant and equipment. Property, plant and equipment include all tangible, non-current assets, including buildings, land, motor vehicles, all of them are part of the PP. So the motor vehicle which was disposed in note number 4, we need to record its accumulated depreciation here. So its accumulated depreciation is 800. So we get the balancing figure here, which will be what? Which will be what? Will be the depreciation for the current year. Depreciation for the current year. Depreciation for the current year. So 800 plus 10430 minus 9240. So, and basically I'm getting a figure of 1990. That is what I'm getting there. Confirm whether you're getting the same. So then we need to record the costs. at the start, the cost at the end, using the information we have in note number 1. So the cost of PP at the start is 33,400. Remember, I said this account we are preparing it at cost here. So the cost at the end is 47,900, like that. And then the revaluation gain. Revaluation gain, remember this one, we have it in the income statement. We have it in the income statement. Income statement. So in the income statement, revaluation gain, which is basically 700 here. Yes. And then we also have the disposal. Disposal, this one is what we have in note number 3. The motor vehicle which was disposed in note number 3. And I've said everything in that account will have to be recorded at cost. So the motor vehicle which was disposed in note number 3, we record it here at cost. Sasa, yes. So what we do, we get the balancing figure which is on the debit side, and that is the PP which were acquired. That is the main objective of preparing that account. What do we have on the credit side? 47,900 plus 2,000 minus what we have on the debit, 33,400 minus 7,000. So in this case, I'm getting 95. 95. Confirm whether you're getting those values, so that now we can be able to move and prepare a statement of cash flows. Are you getting those values? If you're getting those values, you confirm. You confirm whether you're getting those values. Yes, are you getting those values, Dagote and Sharon? Ama swali imekuwa ngumu. Yes, I know this question is a challenging one, but it's a very good question. If you understand it, it's a very good question. It's a very good question on the statement of cash flows. It's a very good question. Zuma, are you getting that? Are you getting those values? Are you getting those values? Are you getting those values? I will presume yes. Yes. So I think now we can be able to move and we prepare our statement of cash flows. But even before we look on we prepare the statement of cash flows, someone may ask, how is this excess depreciation accounted for? This excess depreciation. Now, this excess depreciation, the double entry for this is usually debited in the account which is called the retained earnings. Is it the retained earnings? No. This one, in other terms, let me put it like this instead of giving a double entry. This one, excess depreciation, this is deducted from the revaluation gain. You see, the reason why there was excess depreciation is because the assets were revalued upward. So this one is basically deducted from the revaluation gain. If, for example, you go to a balance sheet, to a statement of financial position under equity, can you go to the statement of financial position under equity? Under equity, can you see we have something called the revaluation reserve? Under equity, can you see something called the revaluation reserve? The revaluation reserve is an amount of how much? Then revaluation reserve, which is under equity, you can be able to see the revaluation reserve. It is 68, but and actually you can see at the start it was 0. So what we know is that revaluation reserve basically arises from this revaluation gain. Can you remember the revaluation gain? The revaluation gain was 700, but I hope you can see the amount which was transferred to the revaluation reserve account is 68 instead of this one. So now this excess depreciation number 1 is deducted from this. That's why you can see the amount taken to the revaluation reserve is 68. So this one is deducted from this revaluation gain, and then number 2, it is added to the retained earnings. It is added to the retained what? Earnings, and therefore, when computing the dividends, remember the other question we did, we were computing the dividends paid using the retained earnings. So when computing the dividends paid using the retained earnings, we must remember to capture this. So to touch retained earnings at the start of the year, and then we will add this amount of 200. Sasa, yes, because this excess depreciation is how it is accounted for. It is deducted from this revaluation gain. It is then added to the retained earnings. Sasa, yes. So when computing the dividend paid, lazima tukumbuke your amount here, 200, to add it to the retained earnings at the start. Sasa, yes. So having that, Let's move and prepare a statement of cash flows as required by the examiner. So the name of the company is 𝐉𝐎𝐈𝐍 Limited. And basically this is a statement of cash flows, a statement of cash flows, which is for the year which ended 31st of October 2025. A very good question on cash flows. Very, very good question on cash flows. Yes, so remember here we said we start by determining the cash flows from operating activities. From operating activities, we need to have two columns here. And basically our figures are in thousands of shillings. Our figures are in thousands of shillings. Are in thousands of shillings like that. So when computing this, we said always start with the profit before tax. Not before tax. Yes, the profit before tax. Always. The profit before tax is an amount of 2880. 2880. Remember, we get this from the income statement, profit before tax, and then we make a number of adjustments to this profit. We make a number of adjustments to this profit,